Hi, I'm Wes Long, President of Index Fund Advisors. Welcome to IFA, where we replace speculation with an education. Today, we are honored to have Wes Crill from Dimensional Fund Advisors in our studio. Wes is the head of Dimensional's Investment Strategies Group. Wes, welcome.
Yeah, thank you. Always good to be here in your studio, and it's good to be visiting with you guys again.
Yeah, great to have you here. Why don't you take just a minute or two and tell us a little bit about you and your background?
Yeah, definitely. So like many of the people at Dimensional, I come from an engineering background. So once upon a time, I was a PhD student studying theory and simulation and nanoscale materials. It's almost as exciting as that sounds. But as I started to come to the end of my educational tenure, I started to think about career paths that would be appealing to me. And one thing that science in that respect lacked that finance seemed to have in abundance is an ability to make an impact in the real world, in real people's lives. And so that was what ultimately led me to Dimensional. It also helped that Dimensional had a very scientific approach to investing, so I could still maintain that aspect of my educational training, and then conducted research at Dimensional for many, many years. And now within our investment solutions group, I get to spend a lot of time talking about our great research with people like yourselves.
And how long have you been at Dimensional?
It's been 13 years now.
Wow, congratulations.
Time flies when you're having fun, right?
Yes, indeed. Well, let's talk a little bit about the world out there today from an investing perspective or an investor's perspective. Macroeconomics. It seems like about this time last year, people were saying, oh, recession's just coming right around the corner. I don't think it really happened, but yet I'm hearing that talk again now in the marketplace. We've got a war going on, unfortunately, in Ukraine. We've now got increased tensions in the Middle East. We've got gasoline prices here in California, close to $7 a gallon. People are feeling the bite of inflation. Why wouldn't an investor just take their money and put it in a coffee can and bury it in the backyard? Why would they continue to do this crazy thing called investing?
Yeah, a lot of consternation-worthy news, that's for sure. So I think we can start at a really broad scale and then start to narrow down into things like the macroeconomic environment. I think anytime you're greeted with uncertainty in markets, whether that's geopolitical risk, recessionary fears, we always like to default back to, okay, what are the things that we think haven't changed, right? There was a famous football coach who once said, you don't rise to the occasion, you sink to the level of your training. So what are your underlying principles you can adhere to? And we still believe that markets do an excellent job of processing information, that diversification is our buddy, is the key to managing risk, and we believe that not all stocks and bonds have the same expected return. So those key principles continue unabated in our minds. Certainly there's flexibility that you like to have within an investment strategy. So if you have things like country-specific risk, maybe there's things you can do to manage risk. But by and large, our principles about risk and return being related and expected returns, being associated with prices, continue. And I think that becomes especially relevant when you think about the specter of a recession. People use different indicators to say whether the probability is increasing. Typically, recessions have been preceded by things like a yield curve inversion. Well, we've had one of those. A market downturn in stocks of at least 20%, but we had one of those as well. But it's hard to really predict the exact onset of a recession. And in fact, what we tend to see in the data is that economic indicators are preceded by effects in the stock market. Like if you look at GDP growth, the relation between lagged stock market returns and GDP growth is actually pretty strong. Contemporaneously, that relation dissolves quite a bit. And so that tells us that market expectations about where we're going, and that's true whether it's the macroeconomic event or geopolitical or any other event that's likely to impact the cash flows of securities, if market participants know about it, if we're reading about it in the newspaper, it's reflected in current market prices. And that means we still expect strong returns from markets.
So if there's indicators out there that we can look at, why wouldn't an investor be able to say, oh, I'm looking at this indicator and I should get out of the market now, and when that changes, I'll get back in? Why can't we do that?
Yeah, the best piece of evidence I have is, okay, let's say that this is the first month of a recession. You have the knowledge of the real-time health of the economy, and you say, okay, the recession started this month. And I say, okay, over the next 3 years, what is the likelihood that my stock market investment is going to be different than just an unconditional 3-year period I pulled at random from the historical data? And what we find is that the cumulative returns for the U.S. stock market starting in the first month of a recession are almost indistinguishable over the next 3 years compared to an unconditional sample of 3-year returns. So what that tells me is if I try and make a decision with my portfolio based on what I'm reading about the economy, it's likely to do more harm than good. It's sort of like the old adage about a bar of soap, like the more you handle it, the less you have. That probably holds true for our investment portfolios as well.
Interesting. And I think I heard you say that the events are reflected in the price, and if I heard that correctly, it is what we talk about here at IFA with our clients, that the current price is the best estimate of the fair price. I think I've even heard Eugene Fama say it's the accurate price here more recently. We probably can debate that, but and that the fair price gives the investor the best opportunity for increased expected return, or to have a better expected return.
Best starting point. Yeah. A fair price means that the market is reflecting its aggregate wisdom, its expectations for the future in current market prices. So if prices are deemed based on changes in that information set to be too high or too low, then you can get a market movement, a change in security prices. And this is backed up by the data, right? This is not just a philosophical principle. We see that every day in global equity markets, almost $700 billion worth of trades are processed on average every day. And that's across millions and millions of market participants, and all of them have a piece of the overall information puzzle. No one knows everything out there, not even for one company, much less every company out there in the market. But by trading, they are bringing their expectations to the table and incorporating them into market prices. And so the real question for investors is, do you believe you can swim upstream against that informational power and do better than the market by trying to outguess, predict things that the rest of the market, for whatever reason, hasn't found? Or do you want to take advantage of that vast wisdom that, by the way, is telling you about systematic differences in expected returns? Not all stocks, not all bonds have the same expected return. The informational content that is a product of market participants is key to extracting that information.
So it seems like over the last 12 months, we're hearing more and more about artificial intelligence, or AI, and in all different aspects of life. But with respect to financial services, does AI provide the opportunity to where all of this is going to be looked at differently, that it'll be able to predict when we can invest and not invest? Or how do you think that AI could be a positive, or have a positive impact on investors and investing?
Yeah, it's an interesting subject, just because I think many people have started talking about it because of the emergence of ChatGPT and some of these other generative AI tools. I think back to probably my first experience with AI was anyone who was a Microsoft Word user in the 90s. If you started typing in Microsoft Word, "Dear so-and-so," a little enterprising paperclip would pop up, Clippy, you might remember him, and say, "Looks like you're writing a letter, would you like some help with formatting?" And in some ways, that is a crude distillation of what AI tools are really set to do, which is to pick up on patterns by processing data and then making recommendations. Like when I get in my car in the morning, my phone says, your estimated time to your office is 20 minutes. And it's picked up on the pattern that I go to work generally every work day, and it's knows my route, and it's making suggestions or giving me information along those lines. So if we think about the relevance for investing, the idea that this could be useful to pick stocks in a way that would do better than the market suggests that it's able to find, these generative AI tools are able to find information that has eluded the capture of other market participants. That strains credulity even in the least. And there's one AI-based ETF. It's actually using the Watson supercomputer that was pretty famous for dethroning Ken Jennings on Jeopardy. It's underperformed the market by a function of about half over its lifetime, going back to 2017. So it's unlikely that an AI tool is going to be able to come up with more information than what we see out there in the marketplace. Even companies, there's a whole cottage industry of thematic ETFs nowadays. There are some for AI-based investments, where companies that are expected to ride the coattail of these, those have generally underperformed the market as a whole. So it's not clear that it's going to give you an edge as an investor. Where it could have applications in the wealth management industry might come down to things like your consumer relationship management tools and software, or maybe it can help synthesize data in a way that it would take a human with traditional computing tools many years, and maybe it can do it in seconds to make helpful recommendations and just organize your overall business flow. But in terms of a get-rich-quick scheme, I think that AI tools are going to disappoint many.
Okay. Maybe it's that it will make information even more available, than it is today, if that's even possible.
It's possible. It can speed up information retrieval. That's actually a good point, yeah.
Which then might ultimately make the current price maybe
even fairer.
Even to Gene's point, the best price.
Yeah.
Right.
I mean, I think it's there's a bit of an analog here to the high frequency traders, where it was whoever captured the rents from that exercise was who got there the fastest. And so setting up a server right next to the NYSE trading floor, you could get there sooner. But then once you have that edge in terms of information retrieval, well, the market is incorporated into market prices, and you no longer have the edge, right? So it's sort of one of those things that, like you said, can make the market even more efficient.
Another interesting topic, and at IFA we hear this a lot, are index funds, and now with ETFs proliferating as they have, particularly over the last year or two. What happens if everybody goes and quote unquote indexes? We get that question a lot, and there are some folks out there that say, well, the markets won't be efficient at that point in time if it's all index funds. What are your thoughts on that?
Yeah, and since I'm surrounded by all these nice textbooks, I almost feel the need to go down the academic kind of geek route. But there is a famous theory behind this, and it suggests essentially that if markets are already reflecting all available information, that there's no mispriced securities, everything's perfectly efficient, then there's no incentive for anyone to go out there and look for information that's not in market prices. So then what happens is you have changes in the information set, and if no one is acting on that, the information is not getting into market prices. It's a bit of a paradox, actually. So what that suggests is there is a threshold over which, if you have too much of the securities trading out there, if it's too much in index-based strategies, then there could be impacts on price discovery. Now, I think we're a long way from that. And part of the reason why is just because an investment strategy is labeled as passive, let's say it's an index fund, it doesn't mean necessarily it's being used passively. So this might be surprising to many out there, but 3 of the highest 10 trade volume securities in the US market are ETFs. So there are people who are probably not necessarily setting up long-term buy and hold positions. They're probably trading in and out of these different securities like the S&P 500 ETF based on their views of the future. That's price discovery. That is reflecting their expectations in current market prices. And so you see many instances like that of avenues towards information getting into market prices that really belies the level of assets that are in these index funds. So again, I think if we're at a point where it becomes less efficient to price securities. The other element here is if active managers leave the space, it's probably not going to be the good active managers, right? It's going to be the unsuccessful active managers. And so if you have the percentage of the industry that's inactive going down, it might be that it's actually getting more efficient because you only have the good ones still left behind.
Well, would they leave the space, or would they just go create another fund to try to attract dollars to that? It traditionally seems like what they do, but...
Yeah. Yeah, it's also not clear that all of them exit the space with poor performance as well, because as long as you're able to garner assets, sometimes the performance is secondary too. But I think it's a real concern in the sense that there is sort of a constraint that you could get to where you don't have enough people out there looking for information that's not in market prices. But it does seem like we're very far from that point.
Yeah, and just to drive the point home a little bit further, when we hear the statistics about the amount of assets invested on the index, quote unquote, side of the equation, it includes what you're talking about, these ETFs that are being basically day traded. That's kind of lumped into that whole total. So it's a little bit...
it's a little bit of a misleading stat.
Yeah.
The other element, and the other sort of direct, observation we have that suggests that this is not a problem in terms of like informational content and prices is if you think all of the assets in an index fund are basically dumb money pushing the prices in a certain direction, what that implies is if you look at the holdings of, say, an S&P 500 ETF, in a year where they have strong flows into those strategies, I would expect that's the tide that lifts all boats, that all of the security prices go in the same direction. Nothing could be further from the truth. You see companies that are at very similar weights in the S&P 500 that move in very different directions, even in a year with big flows. So I think a lot of stuff impacting market prices has nothing to do with index fund flows.
Yeah, we like to tell folks here at IFA, when they close the casinos in Vegas, then we'll worry about there not being the active side of the equation in the market, because I think as long as people have that outlet, there's going to be enough of them that participate.
Yeah, that's a good characterization of it.
Wes, thank you so much.
Of course, always a pleasure. Thank you for your time.
We appreciate having you in, and we appreciate your insights.
Yeah, excited to be here. Thanks.
Thanks very much.